The big squeeze ignites a gold bull rally. Hi, everyone, and welcome to another week of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. It's Monday, so we welcome Alex back to discuss a very fast-moving situation in global markets. It's all happening so quickly, it's very hard to keep on top of it all, but Alex is here today to help us try. So how are you going, Alex?
I'm going really well. Just one headline after another blocking what everyone can't see.
Absolutely. And let's start there because that was a really interesting point that you were sort of talking about in the news today. What was the headline, or from your perspective, what is that headline that was missed? Tell us a bit about that and why it's so important.
So we've obviously seen this week, and from our insights last week, all the banks collapsing in the US, and the Fed having to step in and guarantee deposits. But what everyone else missed in the meantime was the fact that the US is getting awfully close to their debt ceiling. And when I say awfully close, we've already passed it. We passed it on the 19th of January, but because of some tricky Treasury moves like dipping into investments, the US is not there yet, but getting closer and closer. So at the moment in the Senate Finance Committee, Yellen is being grilled. Republicans are proposing a default by no other name because they are saying we want to preferentially pay debt now. So
and that is completely unprecedented, isn't it? We've never had that situation occur in the US.
Never had it before. And it is, with these interest rate rises, it is escalating very quickly. So initially, the US deficit this year was meant to be $1 trillion. Well, 5 months in, we're at 723 billion, and made up of an additional 286 billion in interest payments they weren't expecting. So it is just rapidly escalating.
That is crazy. And it's particularly when you hear those words, I don't think we've processed them yet, that they're considering, or that you've got a government policy, or not necessarily the whole government, obviously, the Republican party, but the fact they're seriously considering defaulting on debt is outrageous. Can you give us a little bit more background in what this debt issue actually is, and what that US banking story is actually telling us about the markets more generally?
Well, let's look at what happened first with US banks. So we've got US banks defaulting at the moment because you've got interest rates going up. We know that they've got a bond risk sitting on their balance sheet. What if the US defaulted? I don't think they will. They're going to fix this. But Fitch has actually come out, Fitch rating agency, and said that they are likely now to lift to drop the credit worthiness of the US government because they keep hitting these ceilings. Now, if that happens, forget what the Federal Reserve is doing by raising interest rates. Bond rates will lift automatically, and that is therefore becomes out of the government's control. So you've got what is now becoming a huge counterparty risk in bonds, and then you've got the Federal Reserve, I guess, putting pressure on interest rates, which is encouraging people into bonds. So you've got now these utter conflicting market squeeze. So the bank risk is encouraging short cash, long bonds, because if you look at a bank now, banks have bought bonds at 0% interest rates. They are losing depositors. And this isn't just going on in small banks, it's going on everywhere. Do not forget, SVP was in the top 25 banks in America, which makes it a big bank. This was not a small bank. Yes. So everyone's talking about the regional banks collapsing and ignoring the fact that SVP wasn't a regional bank. It was a big bank. So you've got this going on in the banking sector, but they've borrowed money at 0%. As depositors try to put money in banks, cash, get higher interest rates for their money, banks can't pay it. So individuals or retail investors are now moving money to bonds because bonds are paying 3-4% interest. But now, with what is going on with the US debt ceiling, there is now a counterparty risk in the bond market, which was the only place anyone was getting any value.
And can I just dig into that a little bit, just to check my understanding on that? Because you mentioned before the ratings agencies, and if they were to decrease that rating, that actually forces a lot of money out, because you have certain requirements from fund managers and all sorts of people that it must be at a certain rating to even hold it, don't you?
Yeah, absolutely. The repercussions of that, the credit rating dropping are huge. And banks that we already know have huge risk on their balance sheet because of these losses that they're holding mark to market are faced with an immediate jump as the bonds, deteriorate even more.
So let's put this in context of the US, because a lot of the arguments that I've sort of been reading and hearing are that the US just gets away with this, right? Because they're the global reserve currency. Ultimately, if their debt is degraded, it makes no difference because everyone's using US dollars anyway. Nothing happens. Do you think that? Do you think the US gets a free pass this time simply because of their status?
I think because there are two huge market forces squeezing both ways this time. And it's always that run to one side, then run to the other. There's no sides left to run to. I think this squeeze is real. I was looking at the ECB, for example. Their banks are generally sounder. I mean, Credit Suisse, excuse from the current situation. And what I was looking at was what's happened with the deficit in with the ECB. So, sorry, what bonds they were holding compared to the US. So, in the last year, the ECB has been able to quantitative tighten and reduce their balance sheet by 1 trillion euros. So, they've gone from 8.83 trillion to 7.73 trillion. So, whatever they are doing is working. And it probably has to do with their rate increases being somewhat slower than the US. The US, in the same time, had about a 9 trillion Federal Reserve balance sheet. They reduced it by 626 billion, got it down to about 8.3. But because of this banking crisis, they've just had to lift it back to 8.6 because they've had to throw some more liquidity in the market to keep these banks alive. So they are unable to reduce their balance sheet. Their interest payments are going up, whereas you've got, we're seeing some success with what's going on in Europe. So in answer to that, long euro bonds and long gold is what is, I think, going to happen in the market.
And that is probably a little bit of a controversial or contrarian take, because I don't think people are set up for that. They really are just assuming that things go on as usual, but that's not guaranteed. And there's a lot of assumptions working there that the US just gets that free pass.
Yeah, and the Fed is destined to raise interest rates again this week. They're sticking to their guns, and their banking, or particularly their regional banking sector, is fracturing. And I think maybe, JP Morgan's and some of these banks that have come in to back First Republic, is it? The First Republic Bank this week. I think they know that there's huge stress in the US government. They wouldn't have come and stepped in unless there wasn't.
No, and I'm actually very curious to see what happens in the markets as a result of that probably, relatively expected 1/4 point raise from the Fed, because that could be pushing it too far. And that they have a real risk of losing credibility there, because the argument is they have to do it because they don't want to lose credibility, but they also have a risk of doing it and losing credibility if the market just completely rejects that response.
Yeah, and it'll be a telling response from the market this time. If they do lift 25 points, it is expected. If the US dollar drops on a raise this time, which, probably a big call, but I think it could.
Yep.
That shows that money's moving out of the US, right? So that will be very telling. The reaction to the US dollar after the Fed will be very telling as to where people are going to go.
This will definitely be one to watch, because you can read from what the market does is what the market actually thinks about this. Yeah. Can we just pivot right at the end? What does this all mean for gold? You've mentioned there that would be an area that you see benefits out of this chaos. Can you just give us a bit more there? Because I know everyone will be very keen to hear your perspective on that.
So we spoke about it probably 2 weeks ago again, about the DXY continuing to go down, not up. because the euro should strengthen on the back of all of this. That is just going to continue. So gold, when we first spoke about it, was probably at about $86,000 a kilo in Aussie dollars. It's now at $95,000, new Australian record on Friday. Not a US record. So we're at 1988 per ounce, I think, in US as of Friday close. And I think the record is 2050. Actually not 100%. So you can clue me up.
There's still room. There's still room to run there.
There's room to grow, but if it's the, if it's a DXY that's breaking down the USD, which is likely, that runs well past the 2050. Yep. So, 95,000 in Aussie, I just think it's got so much room to go. Can't go to bonds. You can't put your cash in the bank at the moment. You've got asset prices collapsing. You've got real estate hemorrhaging, especially commercial real estate at the moment. You've got people running away from bank equities, tech equities. The squeeze is so big into such a small asset class that it should just continue to go up.
It could be absolutely explosive.
Absolutely.
Well, Alex, thank you for all your work on covering this. It's a very rapidly evolving space, and we'll be keeping our finger on the pulse and trying to unravel it all as it unfolds, and particularly that rate decision later in the week. We'll be having our eyes clearly focused on that one. So thank you for your work on that and your continued work going forward.
Thank you for having me again.
Thanks everyone for watching. Remember, if you've got any questions or comments, reach out on the social platforms. We'll get back to you on those. That's us for today. Stay safe in the markets, everyone, as we'll all be watching closely. As I've said, we all want to see what unfolds next, and we'll talk soon later in the week. Bye.